Okay, hi guys. Welcome to my very first session that I have planned out for you guys over the weekend. Yeah, I think that it was interest of mine to really want to share with those who are out there who are really interested to grow your money and knowing how to put in into the right investment products. So I will gladly share with you what I have. Then eventually, when we have our Telegram group chat, that's where we can enrich rich discussion that can help one another to grow together. Okay, so let's start off. Now, as mentioned, my aim is to share my financial journey and knowledge I had thus far to allow everyone to make a better choice on the road to financial freedom. So, these are the few things that I'll be going through. First of all, I think it's very important for us to understand the risk and the appetite that are willing to go through for our investment. And after which, I'll be going through some popular investment products out there, such as bonds, peer-to-peer lending, funds, robo-advisor, ETF stocks, and most importantly, REITs. So let's start by talking about investment risk and appetite. Okay, before you start investing, you got to ask yourself, with this spare amount of money that you have, how long do you intend to invest this money? Are you just someone who just started out working? You have 20 to 30 years to work before you really start retiring, so you have a long investment horizon. And what about your current and future commitment? Is a house coming? Is a baby on the way? Or a renovation to do that you might need the money? And how much are you willing to afford to lose? And from then to which you'll be able to understand what kind of investment tools will be suitable for you. And most importantly, you need to then from there learn how to formulate out a portfolio for you to understand what risk investment will you like to take on. So for example, if you are young, you would like to grow and enhance your returns, you can consider things like stocks and ETF. Or if you have already hit and you would like to draw income on more stable items, you can look at dividend paying stocks like REITs in general that has been very popular within the few years. Or if you are somewhat looking forward to retirement, you have just a few more years to work, and you might want to look at things that are lower risk in which have lower returns such as bonds. Okay, and I'll be sharing my PowerPoint slides with you that has many relevant readings for you to read up to so that you can better understand all this from the websites that are given. So first of all, let's look at bonds. Bonds are mainly about understanding that a company would like to borrow money to issue a bond with a fixed rate agreement over a period of time. So for example, the Singapore governments might be issuing Singapore savings bonds to agree that, look, you agree to borrow me this money over this period of time in which I will give you a rate of return. As of now, I think in June, the current rate is about 1%. Yes. And every bonds that is issued, regardless by the government or any companies, has a credit rating in which to say that how reliable they are in promising to give you back the rate of return when the bond mature. So you recently have seen companies like SIA or High Flux back in a few months' time was hoo-ha over them defaulting over their bonds, and many investors actually lose the money. So looking at risk wise, you need to understand what actually you're going for. Okay, things like default risk, interest risk, and whether it's liquidity or the market risk as well, and the early redemption risk if you were to end the bond early. So rate of return rate is about 0 to 2%, and it's relatively stable if you go for bonds that has AAA credit rating, but it might be lower credit rating with a higher form of return. So that's one form that you're looking at. Another one that has stirred up quite a bit will be peer-to-peer lending. Okay, the concept is rather similar to bonds, but instead of obtaining loan from a company or a government, Instead, these companies come to this website that hosts and allow investors to take up loans from them. Okay, popular ones like Mula Sense or Funding Society, but they have high rates of return. Like you're looking at returns about 10 to 15% of interest after a year of loan. But you got to understand that the risk coming is that as businesses tend to obtain loan from peer-to-peer, as it tend to be less stringent. So you say like if I'm a SME, which I couldn't get a loan from a bank, another alternative I'll look into is to peer-to-peer lending website. So technically, they are like more riskier companies who couldn't get a loan from the bank, and then they decide to turn to peer-to-peer lending sites. So in terms of risk wise, it's relatively high. So there has been cases of default where investors aren't able to get back the money and the sites isn't doing much and anything to go about to do to help them. But as you can see, the rate of return is really high, of 10 to 15% guaranteed, but at the risk of being default. Next, we have funds. So funds is a slightly complex idea in the sense that there is a manager who decides what assets to buy based on the objective of the fund. So for that example, I have given you a screenshot over here of Aberdeen Singapore Equity Fund. You can look at the top 10 holdings. It actually hold on to stocks that you are more or less familiar with. So in the fund, about 15% of the stock goes to the OCBC and 13% goes to DBS and so on and so forth. So in a fund, you get to see things like this. And it need not have to be just equities. Different funds has different objective, and that you will just trust the fund manager to decide what to buy on, and you just let your money grow. Yeah. So risk wise, you're also looking at common stuff like interest rate risk, liquidity and market risk. And most importantly, in order for the manager to do well, you got to be paying him commissions. And commissions would come as a risk to me because I feel that it can be rather high over time as it accumulates. So even though that you may be earning money from the fund, but you a lot of it will be wiped out for you to pay the fund manager. But then again, it is very passive investing because you're trusting the manager to do most of the job for you. So moving on. Okay, next we have the robo advisor, which is in thing now, that you can see that there's many companies coming up. As you can see over here, DBS has started their robo advisors, OCBC as well. So basically, instead of a traditional way where which you go to a bank, you let them know what you want to do with your money, and they, based on their risk appetite and size, they were to suggest a list of assets for you to buy, like bonds, stocks. Instead of that, you have a robot online that through the algorithm that is planned by the company, they will suggest of different asset class based on the risk appetite. So common ones out there you see recently are like AutoWell, Stashaway. Smartly closed down recently in April 2020, and there was a hop-on fee to jump to Stashaway. So what are the risks involved? As these robo advisors plan to allow you to go into foreign market, there's a foreign exposure. Like from my understanding, I personally who uses Stashaway knows that they trades a lot in US market. So if the US dollar were to go down or up, they will adversely affect my portfolio if it gains. So it might be for the better if it's appreciate or depreciate, but it might be for the worse when my portfolio is not doing well and it starts going down. And of course, there's also commission fees to look at when you go on for long term to do investment over say more than 10 years and 20 years. And if the commission fees are high, definitely again, you will be wiping out a lot of your investments earning lah. Okay, next will be exchange traded funds or ETF in short. This has been mentioned quite a few times as well. If you are familiar with the investing scenes, as you can see from the name exchange traded fund, it is actually a type of fund. But instead of the fund manager deciding on what to buy on the assets, they actually track and try to replicate indices like the Singapore Trader Index. So to buy a STI ETF, the two well-known one out there are Nikko AM and SPDR. So for example, you look at STI, you think that, I think that the stocks included in the STI are pretty decent and you don't have money to buy one shares of every single stocks. So instead of doing that, you can actually buy the STI ETF at a much cheaper price and you're able to own shares of all the stocks out there. Okay, so there are ETFs for US market as well, Hong Kong market as well, but this is just an example of how a fund, exchange traded fund can be like to replicate in this. Okay, next we come to stocks, the most common form of liquidity trading. So for those who have no understanding of how stocks is like, so basically what you're doing is that a company decided to offer its shares for you as an investor to purchase. And once you become a shareholder after thinking that, look, oh baby, I think that Singtel is a very good stock to buy. Currently, it's trading at $2, I think, because badly hit by COVID or the recent earnings. And I believe that it has a chance to go up to $3. Then I decided to buy at 2, and once it's 3, I sell, and I'll be able to earn the gain of $1. Yeah, so basically that's how stocks work. So buy low, sell high. Yeah, and how to do that? How do we actually start to trade? Okay, there's many of the questions that my friend has been asking me. Okay, so basically you got to understand that a CDB account is somewhere where your stocks are all being kept, whether you buy or you sell. But in order to do so, you need to get a broker, so-called like a salesman, to do the transactions for you, in which you can see on the picture on the right, there are many major banks are doing it, or security firms as well. So you can have many brokers, but they will be helping you to trade in and out through your CDP account. Yeah, so usually people will be just getting one broker and one CDP account to trade, but if you think otherwise, you know of a better deal, you might be getting more. Next, REITs. Okay, the most talked about thing in the recent years in the equities market. Okay, so basically they are real estate investment trusts. Okay, and what is it different from the normal stocks that you get is that you do not buy to become the shareholder of company, but instead you become a shareholder to a real estate. Okay, there are different categories out there like retail, industrial, or hospitality. There's a total of 7. Okay, I'll be putting out links in my PowerPoint site. They can do a lot of thorough reading. Okay, so what is really interesting about REITs is that it's regulated that they have to do a dividend payout of 90%. Okay, in which to say that if say for example say CapitaLand were to REITs were to earn a total of 1 million that year, they have to take out 900,000 of it and declare as dividend to investors like you. So people really enjoyed and like this kind of stock in the recent years because they provide very, very decent dividends, like say 5 to 6%. And not talking about the capital gains as well, because they have been actively managing the REITs, buying and selling properties to attract investors to come in and invest. So over the years, REITs have actually enjoyed very good returns over the last few years. So basically, I have done a rough outlook and covered some of the really common investment products. And I would like to end off by saying that I think most importantly, why am I doing this is that you need to learn how to grow your money during your active years when you are working. So you'll be able to lead a fulfilling life when you retire. and not having to worry about, look, I'm already 55, and yet I still don't have the financial means of retiring. I'm worried about my child. I'm worried about the house and things like that. Okay, so with this video, I hope that you're able to pick up some ideas of how to invest, what are the things you need to look out for, the products out there, along with the readings I will be giving you to take on and understand what exactly you would like to invest on and put your money in. Whether you are a high risk investor, you are risk adverse, you cannot afford to lose your money, but understand knowing how to build a portfolio out from your risk appetite is really important. Yeah, so that's all for today. I hope I'll be able to do a weekly sharing or once every 2 weeks on things that you all will be able would that things that you all will be interested in, and we can take on our discussion on to the Telegram chat that I'll be setting up. Okay, so thank you. Bye.